Silver just did something it had never done in 50 years. And then, in a matter of days, it gave almost half of it back. From $121 to $74. Billions wiped, traders destroyed, and now everyone is asking the same question. Was that breakout the real deal, or the most expensive trap in a generation? Tuesday, February 17th, New York time. Drop your date in the comments below so I can see exactly where you're watching from. And if this kind of work adds value to your day, hit subscribe and comment George Williams. It genuinely helps more than you know. Let's go back to January 29th, 2026. Because if you weren't watching the silver market that day, you missed one of the most extraordinary moments in the entire history of commodity trading. Silver touched $121.67 per troy ounce. Let that sink in for a second. $121. For context, silver had been stuck below $50 since 1980. 46 years of resistance, 46 years of false dawns, 46 years of silver bulls getting humiliated every single time they thought their moment had finally arrived. And then, on one Tuesday in January, it didn't just break through 50. It blew past it like it wasn't even there, and kept going, all the way to $121.67 before anyone could even catch their breath. The energy in trading rooms, in Reddit threads, in Telegram groups, it was electric. People who had been holding silver for years, some for decades, were watching their positions double, triple, go parabolic in real time. Financial headlines that had ignored silver for years were suddenly splashing it across front pages. Retail investors who had never touched a commodity in their life were opening accounts trying to get a piece of it. It felt like the moment everyone had been waiting for. And technically speaking, there was a very serious, very compelling reason why. For years, and I mean years, technical analysts had been pointing to something on silver's long-term monthly chart called a cup and handle pattern. Now, if you've never heard that term before, don't worry, because it's actually one of the most intuitive patterns in all of technical analysis. Imagine you're holding a coffee mug. The cup is that big, smooth, rounded bottom. The market falls, bottoms out, curves back up, and returns to where it started. That's the cup. Then the handle is a small dip to the right, a brief pullback, a moment of hesitation, before the price finally breaks above the rim of the cup and launches higher. The whole idea is that the bigger and longer the cup, the more powerful the eventual breakout tends to be. And silver's cup had been forming for 50 years. 50. The rim of that cup, the resistance level that had capped silver's price since 1980, sat right around $50 per ounce. The handle formed beautifully in the years leading up to 2026, and when silver punched through 50 and rocketed toward $121, every technical analyst on the planet was pointing at their charts saying, "This is it. This is the textbook confirmation. This is the breakout that changes everything." And then the trapdoor opened. Here's what most people don't understand about what happened next, because the mainstream coverage completely missed the mechanism. When silver broke out and started going parabolic, the CME Group, which is the exchange that governs futures trading for silver in the United States, quietly but devastatingly raised the margin requirement on silver contracts from 11% to 15%. Now, what does that actually mean in plain English? When you trade silver futures, you don't put up the full value of the contract. You put up a percentage, a deposit essentially, and borrow the rest. That's leverage. And leverage is a double-edged sword that cuts both ways with equal ferocity. When CME raised the margin requirement, every single trader who was holding leveraged silver positions suddenly needed to come up with more cash, immediately, or be forced to close their position. Not tomorrow, not next week, right now. And when thousands of traders are all forced to sell at the same time, the price doesn't decline. It collapses. It wasn't that the fundamentals changed. It wasn't that silver suddenly became less valuable. It was a mechanical, structural, forced liquidation cascade, and it was brutal. People who had ridden silver from 50 to 120 were wiped out on the way back down. Accounts that had doubled in weeks were margin called into oblivion in hours. U.S. Treasury Secretary Scott Bessent went on record attributing the extreme volatility to Chinese speculative trading, calling the January rally a speculative blow-off. And he's not entirely wrong. Chinese traders had been enormously active in the silver market in the weeks leading up to the all-time high, pouring capital into both physical and paper silver with an intensity that amplified every move. But here's the thing, and this is important. As of right now, those Chinese traders are on the sidelines. Chinese New Year runs from February 16th through February 23rd. The market that was partly responsible for pushing silver to $121 is currently quiet, which means this week, right now, is one of the most pivotal and unusual weeks silver has seen in years. Because when that liquidity comes back, when Chinese traders return to their screens after the holiday, the direction they push first could tell us an enormous amount about what comes next. So let's talk about whether this breakout was real. Because despite everything, despite the crash, despite the margin calls, despite Besant's comments, there is a genuinely powerful case that the long-term breakout is still intact. Start with supply. For 4 consecutive years, global silver demand has exceeded what mines can physically produce, by somewhere between 160 and 200 million ounces every single year. Every single year. The Silver Institute expects 2026 to be the 5th straight year of structural deficit. You cannot manufacture silver out of thin air. You dig it out of the ground, and right now the ground is not keeping up. And demand isn't slowing down, it's accelerating. Solar panel manufacturing alone is consuming more silver than at any point in history, and projections show that number climbing dramatically through the 2030s. Electric vehicles need silver. AI data centers need silver for their circuit infrastructure. Advanced medical devices, 5G networks, aerospace components. The list goes on, and nearly none of these applications have a viable silver substitute. This isn't a speculative narrative. This is industrial reality, and it creates a floor under the silver price that gets harder to break through with every passing quarter. Then add the macro environment. The Federal Reserve is currently expected to cut interest rates by approximately 60 basis points before the end of 2026. Markets aren't pricing in one token cut, they're pricing in a genuine easing cycle. And here's what history tells us about precious metals in easing cycles. They tend to perform extraordinarily well. Lower rates mean a softer dollar, and a softer dollar means silver, which is priced in dollars, becomes simultaneously cheaper for international buyers and more attractive as a store of value. Both forces push in the same direction. But now let me give you the honest bear case because you deserve the full picture. If this 50-year cup and handle breaks down, if it turns out January 29th was not a breakout but a blow-off top, the technical consequences are severe. A failed breakout of that magnitude and that duration doesn't just mean a pullback, it can mean years of sideways movement or worse. The critical number to watch right now is the 50-day exponential moving average, which currently sits near $78.50. Silver closed today at $74.76, which means it is already trading below that level. A sustained close below the 50-day EMA, not just a day or two, but a genuine breakdown with momentum, would be a serious red flag. It would suggest the bulls have lost control of the trend in the near term, and it would open the door to a much deeper corrective move. There's also a policy wildcard that markets are only beginning to price in. Reports indicate that Kevin Warsh, a known advocate of dollar strength and monetary restraint, could replace Jerome Powell as Fed chair as early as May. If that transition happens and shifts the Fed's posture in a more hawkish direction, the rate cut narrative that's been supporting precious metals could unravel quickly. A stronger dollar environment is historically one of the most reliable headwinds silver faces. So where do analysts actually see prices going from here? Bank of America has a 2026 average silver target that reflects a market structurally higher than where we were a year ago. UBS revised their silver forecasts upward by $5 to $8 per ounce earlier this year, with a baseline target around $60 and upside to $65. But the technical analysts, the chart readers, are looking at very different numbers. The first major resistance on the way back up sits at $100 per ounce, a psychologically and technically significant level. Beyond that, the more aggressive forecasts, and these are real analyst projections, not social media speculation, put silver at $200 to $300 per ounce if the parabolic move resumes through Q2 2026, with the structural fundamentals continuing to compound underneath it. So what actually happens next? Realistically, there are 3 paths from here. The first is consolidation. Silver grinds sideways, builds a base somewhere in the $65 to $80 range over the coming weeks, absorbs the shock of the margin call crash, and then slowly begins rebuilding bullish momentum for a resumption of the uptrend later in the year. This is actually a healthy and common outcome after violent parabolic moves. The second scenario is a deeper flush. Silver breaks decisively below the 50-day EMA, finds no support, and slides toward the $60 to $65 zone before long-term buyers step in with conviction. That would hurt in the short term, but it would also reset sentiment and potentially create the cleanest launching pad for a sustainable move higher. The third scenario is the one the bulls want. Silver reclaims $78.50, holds it, and uses this week's U.S. jobs data and CPI release as the catalyst to push back toward triple digits. This week's macro data is genuinely important. A softer than expected inflation reading or a weaker jobs number would give the Fed more room to cut, weaken the dollar, and light a match under precious metals. Watch those numbers carefully. What I want to leave you with is this. The 50-year cup and handle in silver is one of the most significant technical patterns ever identified in any asset class. The fact that it broke out, even temporarily, above a resistance level that held for nearly half a century is not nothing. That matters. Whether January 29th was the real beginning or a premature false start, silver's fundamental story hasn't changed. The deficits are real. The industrial demand is real. The macro tailwinds are real. The question is not whether silver eventually reflects that reality in its price, it's when and from what level. So I want to hear from you. Do you think the breakout was real, or do you think it was a trap? Drop your answer in the comments, and while you're down there, tell me where in the world you're watching from today, Tuesday, February 17th. And if you haven't already, subscribe and drop a comment that says George Williams. It genuinely means a lot, and it helps this channel reach people who need this kind of analysis. Stay sharp, stay patient, and I'll see you in the next one.